In this presentation, we're going to move on to the vendor section and look at one of the major forms related to the vendor section. That will be entering a bill from a vendor, a bill to us. A bill is something that we're going to owe. Let's zoom into it with Xero. Here we are in the demo dashboard for Xero. We're going to be looking at or making our financial statements first. Let's open up our good old financial statements. We're going to go to the accounting. We're going to go down to the balance sheet. We're going to be opening up the balance sheet as is our custom anytime we're working in our accounting software. I'm going to right click on the tab up top, duplicate that tab, put it in the form to the right. Where we'll do the data input on the left. I'm going to go back to the left and do the same thing for the P&L, profit and loss, or income statement, as it's called here, the income statement. We're going to then be opening that up. I'm going to right click on the tab up top. Once again, we're going to duplicate that tab. So our major financial statements to the right, we're then going to be moving to the left to enter any data into it. We're then going to go down to the QuickBooks Desktop just to take a look at the flow chart. So we're now moving here from the more complex customer cycle to the less complex, generally, unless you're dealing with inventory, vendor cycle. So on the vendor cycle, if you're not dealing with inventory, the vendor cycle is fairly straightforward, right? You got bills, and then you're going to enter the bills, and then you're going to basically pay the bills. Now, remember, the term bill to us means, for our accounting software, both QuickBooks and Xero speak this way. The bill means that it was a bill to us, something that we owe. So bills are kind of like bad. But an invoice, which is basically the same thing on the other side of the transaction. So an invoice, for our purposes, for the accounting software, represents something that we sent someone else. So we, in essence, billed someone else. It would be bad for them because they have to pay something. It's good for us because it represents money that's coming in. So these two things are just two sides of the same transaction, depending on what side you're on. Bill for the software means that we owe something. So we might receive a form, in other words, that says invoice on it, but to us it's a bill because it's their invoice, it's our bill. Okay, so if we enter the bill into the system, it's going to be going into the system, increasing accounts payable, a liability account, and the other side is going to be going to possibly an expense account, usually, or if we purchase inventory, an inventory account. Then, of course, we're going to pay the bill. When we pay the bill, we're basically writing a check or doing some other kind of payment, checking account going down, the other side decreasing the payable. Now, many small companies, if you're talking about a small company, may not be doing this so much because they might just be on a cash basis with regards to the payable section, meaning you may just be paying whatever you need to pay as it comes up and not tracking the bills for it. The larger the company is, the more likely you're going to have to enter the bills into the system in a payable situation and then sort them and think about which bills you want to pay. Then think about paying them and pay them at a future time, in which case you'll be navigating and adjusting through the accounts payable section, the accounts payable ledger, the accounts payable account, in a similar way as companies would be dealing with accounts receivable. So in other words, small companies, if you're dealing with a smaller company, you may be more on a cash basis completely. In other words, you might not be going through accounts receivable, but just getting paid basically maybe even electronically. And you can in essence just be on bank feeds or whatever to be dependent on the bank. Or many companies are dependent, the larger a company gets, that's or the different industries you're in, you may increase and need to track the receivables and need to invoice and track who owes you money. But you may not be all as interested in the payment side because you're basically paying on a cash basis. And then as you grow a bit more than that, usually that depends on size and type of industry, and then you're going to want to sort the bills more possibly, or you need to track inventory payments. And in that case, it gets more detailed in terms of the vendor payment and having to track the vendor payment. So in essence, though, these are going to be the major two forms that are going to be involved. We enter the bill and then we pay the bill. So first we're going to think about the entering bill, and remember that increases the liability, accounts payable, and then it increases either an expense or whatever we purchase. If it was inventory, an asset, that being the inventory asset. Back over to Xero, let's go ahead and enter a bill just to practice that. We're going to select the plus button over here. A couple ways to get into the bill, but I like to go into the plus button, our major forms, our data input forms here. And then I'm going to go to the bill. We select the bill item. And then we're going to say who the bill was from. Now, when you start typing down here, you're going to get some different vendors down below. I'm just going to make up a new vendor here. I'm going to say Verizon, which is a phone company. You can see it indicates here that it's going to be a new item. I'm going to select the drop down. I'm going to be choosing February, let's say February 5th again. We're going to go February 5th. and then it's going to be due on the 19th, depending on the terms. You could change the terms here so that we're going to enter the bill, and you can imagine in this case getting the phone bill, entering it into the system. It's not due yet, but I'm going to enter it into the system when we got the bill, and that'll be closer to the point in time that we actually used the service of the phone bill, right? Rather than waiting until the end of the month when it's paid, when it's due. So if I enter the bill when we get it at the beginning of the time period, even if I don't pay it at that time, I will be more proper in terms of recording the expense in the point in time that we consumed the actual phone. And then I can also sort the payments that I owe more easily at that point and decide which bills I need to pay and when. So then we're going to have the due date on it, which you could put directly from the bill if you so choose. And then I'm going to go down and we're going to put the items, or not the items in this case. If you had inventory items that you would be selling, you can then put the inventory item here if you are purchasing inventory, which would be increasing the inventory. If you're not purchasing inventory, then you don't need the item. You may not need the description or the quantity. This first half is going to typically be dealing with the purchase of inventory. And so then I'm going to go over here to the account. I need to select the account that's going to be affected. I'm going to put it into the telephone. Let's see if we have a telephone account. Notice I typed it in there and it populated for us. So I kind of tried to find it rather than scrolling through it. I'm going to select that item and say tab. And then I'm going to put the region. I'm just going to say West Coast. And they won't let me just populate the amount. So I'm going to put the quantity is going to be 1. And then the unit price is going to be 50. So I'm going to put 50 at 1, and it's just going to be Verizon. Again, it's not an inventory item. We're just going to be entering a bill, normal, basically bill. Okay, so then we're going to say approve. Well, what's going to happen when we do this? It's a bill. What a bill means is accounts payable is going to go up. So accounts payable is going to go up. The other side is going to be going to an expense account, that account being the telephone and internet. Let's go ahead and approve and see if that is indeed the case. So it says it has been approved up top, so I'm going to go back to the balance sheet. I'm going to update the balance sheet. Actually, I need to change the date for the balance sheet. Let's change the date up to April. I think that's far enough, and then update it again. Now we're going to scroll down to the liability section. Here's the accounts payable. Let's go into the AP liability. And then down here in February, here's our bill, Verizon. I spelled it wrong. Verizon. Okay, Verizon. We're going to go into that $50 for Verizon. And you could obviously go into the vendor and fix that. I'm not going to do it now, so I apologize for the spelling error. So here it is. So here's going to be our bill. And then I'm going to go back. So let's go back to the balance sheet. Now the other side's going to be on the income statement. So if we then go to the income statement, and I'm going to update the income statement to see that it picks up our amount. Then scroll down. We're looking for the telephone expense down here. There it is, telephone and internet. So I'm going to go into the telephone and internet. And then if we scroll down to the telephone and internet, there's the Verizon bill. And again, if you clicked on that, of course, it would take you back to the bill once again. I'm going to go back. The other thing it's important to note, just like the accounts receivable, I'm going to go back to the balance sheet. Let's see if we can go back to the balance sheet here. Just like the accounts receivable needed supporting information by vendor, the accounts receivable needed supporting information by customer, who owes us the money. The accounts payable needs supporting information as well. If I just drill down on this and I see the transactions by date, that's not enough. I need to know who we owe the money to. So one way we could do that is we can go back to the first tab and let's take a look at another report. So I can go to the accounting and take a look at another report. So let's take a look at the purchases here. We're going to be taking a look at the age payable summary. Let's take a look at the age payable summary report. We're going to change the date up top and we're going to bring this out to April. So April 30th and then update that report. And this gives us our information by how old it is and also by the vendor. So if I scroll down by vendor, you can see the total here tying out to that 10,341.84. That should match what's going to be on our balance sheet over here for the payable 10,341.84. So we could tie this out. We need to know who we owe, in other words, and these are going to be the vendors we owe and also the detail about how old those items are. Now, also, if we go back to the dashboard and we want to track this information, we can go down below to the bills you need to pay section. And then here's the bills awaiting payment. So we'd want to go into the bills awaiting payment or the bills that are overdue. So I'm going to go into the bills awaiting payment. And so here's going to be our information regarding that. So the amount that has been paid if we made some kind of payment on them, and the amount that is due if we were to select one of these items. We would go back into the bill, and in a similar fashion as with the invoice, we can make the payment down below. So we can actually apply the payment out down below if we so choose.